Welcome to Money RX for CRNAs and nurse practitioners. I'm Brett Fellows, certified financial planner. Today, we are answering a question that I hear pretty regularly from CRNAs and nurse practitioners who are within 5 years of retirement. Brett, should I pay off my mortgage before I retire? And the honest answer is maybe. But the more important question is this: where is that payoff money coming from? Because for a lot of high-income nurses, the danger is not the mortgage. The danger is pulling a giant check from the 403b or 401k to make the mortgage disappear. Here's what I mean. A senior CRNA or nurse practitioner sits down with me in her early 60s. She's been with the same health system for the last 23 or 24 years, and her 403b is somewhere between $2 and $3 million. She has a mortgage balance of $250,000 at a rate that she had refinanced back in 2021. So let's call it a 3% mortgage rate, give or take. So she comes in already knowing what she wants to do. She says, Brett, I want to walk into retirement debt-free. I saw my parents, they paid off their house. This is what people do. And frankly, we have enough money in the 403b to write the check. So let's just be done with it and move on. Now that instinct, I respect it. There is nothing irrational about wanting to enter retirement without a mortgage payment. It is the responsible move, and it, of course, is the move you've been told your whole life to make. But the version of that move, where the check comes out of the 403b or 401k, is an expensive one. And here's the part that most people miss. The wrong payoff strategy can turn a $228,000 mortgage into a roughly $190,000 planning mistake. Not because paying off the mortgage is bad, because the money came from the wrong place. So in theory, she paid 5 times the cost of the debt to retire the debt. And she did everything the responsible advice told her to do. And if you're within 5 years of retirement, this is exactly the kind of decision we help CRNAs and nurse practitioners model before the mistake gets made. And actually, before I get going, I want to let everyone know that we are currently accepting new clients this summer at Oak Capital Advisors. Comprehensive financial planning, investment management, and tax planning. If you are a CRNA or a nurse practitioner, check out our website to book a discovery call with me. Okay, let me show you how this all happens. I'm going to introduce you to Imani. So Imani is a 60-year-old family nurse practitioner, and she's going to retire this December. Her husband, Devin, retired last year, and Imani has $1.7 million in her 403b. Now, Devin has a small pension. They have $85,000 in a brokerage account and about $40,000 in cash. They have a $228,000 mortgage at 3.125%. They have a very normal goal. They want to retire debt-free. So when Imani came into our planning meeting, her plan was simple. She wanted to pull $228,000 from her 403b and pay off the house in January. Now on paper, this is clean. In real life, this is expensive because there are 3 traps hiding inside this one decision. And the first reason is that every video you see or every Google search you do will skip the same variable, meaning everything will ask you the same question. Is your mortgage rate lower than your expected investment return? Now, on face value, that sounds smart, but for her, it was the wrong question because that comparison was built for a household where the money is sitting in a checking account or a brokerage account. The kind of household that, frankly, most of personal finance industry was designed around. But for a nurse whose net worth lives 80% inside of a pre-tax 403b, Well, that comparison breaks before it even starts. Because again, her payoff money was not sitting in a checking account, it was sitting inside of a retirement account. And money inside of a retirement account is not free to use. Once you pull it out, you pay tax on it. You increase your taxable income and you trigger other costs before one single dollar ever touches that mortgage. And for most retirees, the mortgage interest deduction does not rescue this math. Most households are using the standard deduction now, so I would not let the deduction drive this decision. But back to Imani. So she was framing this as a rate versus return question because that's the question every source was trying to answer for her. But the actual cost that she was about to absorb was not on any chart that she was looking at. So she was bringing the wrong tool to the right question. And the cost that she wasn't seeing has a very specific structure to it. There are 4 numbers stacked on top of each other. And most households will pay all 4 without realizing that they're separate bills, which naturally brings us to reason number 2. 1 withdrawal equals 4 bills. What do I mean by that? So a $228,000 403B withdrawal does not arrive to you as one clean check. Think of it as it has to walk through 4 toll booths first. Federal tax, state tax, ACA subsidy loss, and future Medicare surcharges. Let's talk about each of these. So bill number 1, federal tax. That withdrawal pushes Imani's household through 3 brackets in a single year. So the marginal dollars land in the 22 to 24% federal tax brackets. So total federal tax on the withdrawal is roughly $42,000. Bill number 2 is state tax. So most states are going to add another 4 to 6% on top of it. Let's call it $11,000. Bill number 3, the ACA subsidy. So Imani is 60. She's still 5 years away from Medicare. So she was counting on a marketplace medical insurance plan with tax subsidies in those gap years to reduce the premium. But a $228,000 withdrawal completely vaporizes her subsidies for the year. So that alone is another $14,000 in medical premiums that she was not planning to pay. And bill number 4 is IRMA. So IRMA is delayed, which is why people miss it completely. When Imani does enroll in Medicare at age 65, her Medicare premiums are based on income from 2 years ago. So if a large 403B withdrawal lands close enough to your Medicare age, it can show up later as higher Part B and Part D premiums. So we add all 4 of those bills together, and the cost of that withdrawal, before we even talk about what that $228,000 would have grown to if it had stayed in the 403, is over $70,000. So let's now add the loss compounding. $228,000 at a modest 5% return compounded through age 73 when RMDs kick in. Well, that's another $120,000 of growth that she just gave up. So the total real cost of writing that check was roughly $190,000. Now, the reason this decision is so often catastrophic and so rarely caught is that the cost that I just explained is fragmented across 4 forms that a household never reads side by side. Think about it. Federal tax shows up on the 1040, state tax on the state return, ACA subsidy loss on the 1095A, and IRMA shows up as a surcharge on Medicare premiums 2 years from now. So nobody is adding these all up on one page, so they don't see the $190,000. Yes, they see the $42,000 federal bill and they tell themselves that that's the cost, but it isn't. And guess what? There's one more piece. And it's the one that makes this question worse the closer Imani gets to the door that is retirement. Which brings me to reason number 3. The worst time to make this decision is the month of January in your first year of retirement. Most households wait until the moment they retire to make this decision to begin with. So the check gets written within the first 90 days. You have your final day at the hospital, you write the check, and you walk into retirement debt-free. Again, this is emotionally clean, and it feels like the kind of crisp, finite move that responsible adults make. But that timing is the worst possible timing for 2 specific reasons. And the first is what's called sequence of returns risk. So our first years of retirement are very fragile, specifically the first 10. If you pull a large chunk from the portfolio as retirement begins, especially during a down market, those dollars never get the chance to recover. So you are not just spending money, you are removing future income producing assets at the worst possible time. And second is the ACA medical insurance runway interaction. So the years between your final paycheck and Medicare are the cheapest tax window the household will ever see. When you have low, if any, W-2 income, you have a big standard deduction. So there's a lot of room for Roth conversions at the 12% bracket instead of the 22% bracket later. That window is a planning asset worth real money, often 6 figures over the length of that runway. So a $228,000 withdrawal in year 1 collapses that entire window. So Imani doesn't just pay the tax costs on the withdrawal. She loses the entire runway of low tax Roth conversion room that sits behind it. Now, when we modeled Imani's household 2 different ways, the gap was pretty striking. So in version 1, we did a lump sum payoff of the mortgage in January from the 403B. Again, lifetime federal tax bill, roughly $190,000, higher than had she carried the mortgage to its term. And her ACA runway plan was half destroyed. In the second version, we took $25,000 per year of extra principal payments, starting 5 years before retirement, funded from her current cash flow. With this, her mortgage would be gone at age 62, 2 years before Medicare. Her 403B was never touched, and her ACA runway is intact. Now, the lifetime cost of that decision is roughly $9,000 in foregone yield from the accelerated principal payments. So same goal, same mortgage, same household. One path costs roughly $190,000. The other costs roughly $9,000. The difference was not discipline. Imani had plenty of discipline. The difference was sequence. So 3 problems. 1 question asked without the variable that actually decides the answer. 1 withdrawal that turns it into 4 bills that nobody adds up together. And 1 timing decision that compresses the worst year of a runway into a single check. Now, they look like 3 different mistakes, but they're really all the same one. So Imani doesn't need a sharper answer to should I pay off the mortgage. She needs a different question, asked across a different timeline with the source of funds literally named out loud. The decision the household is actually making is not binary. It's a sequencing decision. So what changed for Imani and Devin wasn't picking the right camp. It was building a runway underneath their decision. So let's talk about building this runway. The mortgage payoff runway is a 5 to 7 year plan that retires the mortgage from current paycheck cash flow during your last working years. And by the time the household stops earning, the mortgage is either gone or it's close to it. and the retirement accounts are intact. And therefore, the household enters into retirement with the emotional payoff and tremendous financial efficiency, both at once, with the source of funds question answered out loud. So there are 3 moves to run in this order, and frankly, any nurse household within 7 years of retirement can start this in the next 90 days. So move number 1 is decide whether the mortgage gets paid off at all. This is the only time that the rate versus return math actually matters. And the answer, of course, is different at different rates. At 3% and below, the mathematical case for paying it off is weak, even if you have the cash. The case from paying it off from a retirement account is catastrophic. Just don't do it. At a mortgage at 5% or above, the math case for paying it off from cash is reasonable. Even from a retirement account, it's sometimes defensible, although usually still pretty expensive. But between 3 and 5%, the answer depends on the household's appetite for fixed expenses in retirement and on the survivor income picture. What I mean by that is, if something happens to one spouse, can the other one comfortably cover the mortgage on the survivor's income alone? And if the answer is no, that pushes the case for paying it off faster. So the point isn't to skip this question. The point is to make it the first question, not the last. Now, the second move is if the answer is to pay it off, you want to build your runway for it. So literally list the remaining years of your full salary. Divide your mortgage principal by that number, and you can add a buffer for taxes and interest. Now, the result is the annual additional principal payment that needs to come from your current cash flow. Again, for Imani and Devin, that number was $25,000 a year for 5 years. They funded it by redirecting Imani's last 5 years of her excess savings. So money that was going into the brokerage account, they didn't have to reduce their lifestyle. They didn't have to touch their retirement. They just changed where that extra savings landed. And the third move is to protect this runway from the retirement account. So this is the part the household has to actively defend. Defend your retirement accounts. The instinct, especially as retirement gets close, is going to speed this up. To just draw 50 or 100 grand from the retirement account for one big year and knock the balance way down and finish it early. Do not do that. The whole point of building this runway is that it never touches the retirement accounts. The moment a 403b or 401k dollars enters into this plan, the math goes back to the lump sum version. Now, if the runway doesn't fit in the timeline available, the answer still isn't to draw it from your 403b or to 401k. It's to carry a smaller mortgage balance into retirement and then pay it down post-retirement from the household's normal monthly cash flow, whether that's funded by Social Security and pension or distributions. So each of these 3 moves resolves one of the 3 problems. Asking the rate question first eliminates the "of course we pay off the mortgage" reflex. And building this runway routes the principal payments from your current cash flow, where frankly the dollars cost $0 for you to produce, instead of taking them out of the retirement account, where every dollar costs 35 to 40 cents to produce. So protecting this runway from the retirement account ends the timing problem. And here's what this looks like for Imani and Devin. Again, as I mentioned, they redirected $25,000 a year from Imani's final 5 working years from her brokerage account into additional mortgage principal payments. By the time she retired in December, the mortgage balance had dropped from $228,000 to roughly $90,000. She carried that small $90,000 balance into retirement. And then over the next 4 years, she paid it down from monthly cash flow funded by Devon's pension and Social Security. So her 403B was never touched for mortgage purposes. And the total real cost of this runway plan for them relative to never paying off the mortgage at all, it's roughly $9,000 over 15 years. Now, the total real cost of their original lump sum plan, remember, was roughly $190,000. So either outcome, they get the same emotional outcome. They're debt-free. They're 4 years into retirement, but they take a different path. $9,000 instead of $190,000. The decision did not change. The path to it did. And one more thing this runway buys them. A paid-off house in retirement means a lower required portfolio withdrawal every year. So a lower withdrawal means lower MAGI, or modified adjusted growth income. Lower MAGI means bigger ACA subsidies before Medicare and Roth conversion room inside that calendar window. So the paid off house is not the finish line. It's the lever that makes every other planning move easier. And if you've watched the conversion calendar episode that we did, this is where the two videos plug into each other. So there are 3 things for you to take away from today. First, the question that matters is not whether to pay off the mortgage. It's where does the money come from? Second, a $228,000 withdrawal from a retirement account is not one bill. It's 4. And the 4 together can cost 5 times the interest the household was trying to avoid. Third, the runway is what makes the right answer cheap. 5 years of cash flow beats 1 year of withdrawal every time. If you are within 5 to 7 years of retirement and wondering whether to pay off the mortgage, do not make that decision by looking at the interest rate alone. Model your source of funds, the tax cost, the ACA years, the Medicare premium impact, and the Roth conversion window. Again, this is exactly what we help CRNAs and nurse practitioners do at Oak Capital Advisors. The link in the show notes will take you to a complimentary discovery meeting, and we can, of course, walk you through your mortgage rate, your 403B balance, your retirement timeline, and the exact numbers for your case. Thanks for listening to Money RX for CRNAs and nurse practitioners. Again, I'm Brett Fellows, and until next time, take care of yourself and take care of your money.
This podcast is for informational and entertainment purposes only. It should not be relied upon as a basis for investment decisions. This podcast does not engage in rendering legal, financial, or other professional services.